Okay, just for those who don't know us, Kenny's the good-looking one on the right, I'm the one on the left. So let me just start by just a couple of stats. Citibank are estimating that the banking sector will lose 1.3 million jobs over the next 5 years to fintech industries. Experts predict there's going to be more than 30 billion connected devices by the year 2020. According to Forrester Research, most companies are only analysing 12% of their current data, and annualised spending growth over the next 5 years is going to be 24% per annum in the life insurance industry worldwide. It's probably going to be the only sector where you're going to see employment growth within that industry. The other thing is, when I'm going to be talking about life insurance and some of the disruptive forces that may be there, I'm going to take a little bit of poetic liberty in talking about more financial services, even more broader. So there is going to be connections into banking, general insurance and life insurance. Interesting, in the Financial Review yesterday, it was reported that the global banking industry is asking for $200 million US to actually spend on investigating blockchain technology and how that's going to impact the banking sector. Okay, let's just start off with talking about what is a disruptor. Look, a disruptor is more than just innovation. It's innovation that actually creates a new market and or a value network, and we're going to use this term value network throughout our presentation. And it usually displaces market leaders and alliances. So is disruption something that should be feared by the insurance companies or the insurance industry, or is this something that they should consider about harnessing to actually improve their customer experience? So we're going to probably start off by looking at the broader market and disruptors within that, and then take it then through to the life insurance industry, and then look at some very specific type of disruptor technologies and how they potentially could be displacing the market. So if we look at recent disruptions, as I mentioned before, typically we do see that that creates a new market and or value network, and it does displace leaders and alliances. What we also see is that it can often drive societal change and operate at a low cost. In other words, one of the value propositions often is that it is at a lower cost and or more choice. And we do see from time to time that it does generate controversy and leverage trends. What we're showing you at the bottom of this page here is Google Trends, and of course it must be true then. And this is showing you the terminology disruptor and how often that's coming up through either through search engines or through articles, etc. And you can see here it really kind of started to come through disruptor in an industry in the mid-90s. Slowed down during the GFC for obvious reasons, but we've now started to see since the GFC a significant increase in the use of disruptor within the internet. And I suppose the question here is, why do we think that's so? Oops, wrong way. What I want to do here is actually look at a few broader markets and look at the disruptors and the lessons that we learnt from that. If we actually look at the first example here, not all innovations are actually disruptive. And if I go back to the development of the automobile back in the kind of mid to late 1800s, initially that wasn't disruptive. It was actually very innovative, but the car was a very expensive luxury, and so it didn't really in any way displace the horse-drawn vehicle. It really wasn't until 1908 when Henry Ford developed the Model T Ford, and it was the Model T, and that was a lot more, and it was mass-produced, and so the cost came down substantially. And so really it was the mass production of the automobile that actually displaced the horse-drawn vehicle, and hence being the disruptor there. So the lesson learned here is really make it cheaper. Now, it's interesting, a quote from Henry Ford was, well, if I'd asked the customer what they wanted, they would have told me a faster horse. I mean, an interesting quote, but it could have easily come from Steve Jobs today. What we're also seeing here is that for other disruptors, they're actually harnessing the power of others. And so if you look at, if you look at Facebook, which is the most popular media provider, actually creates no content. If you look at Alibaba, one of the most valuable retailers in the world, it actually has no inventory. And then if you actually look at Airbnb, largest provider of accommodation in the world, it actually owns no real estate. What we're really seeing here is that digital technologies, rather than reducing human interactions, they're now capable of facilitating sharing and connections in the real world. And so the lessons you can see here from Airbnb is the facilitation here is leveraging the sharing economy. For the last example here, disruptors are sometimes just make the customer experience a lot better. When we look at Uber, which is growing significantly over the last 5 to 7 years, it fundamentally provides a platform that makes it easy for passengers and drivers to connect to basically provide a service. It's another interesting example, Uber, because often for certain industries, it's often quoted that it's a highly regulated market and that's going to make it hard for a disruptor to enter. Well, the taxi industry was actually a very highly regulated market in a number of different countries, including most states in Australia. And Uber has actually been able to displace the various regulations and actually then secure a significant foothold. Now, sorry, I should say the lesson learned for make it participative. For Uber, it's make it easy. Now, I'm not suggesting that that's the only lesson for each of these. Of course, if Uber was more expensive than taxis, I'm sure it wouldn't actually take off. So there's an element of make it cheaper, but the key driving force or lesson there is make it easy. So let's now move over to what we see within the life insurance industry, and do we think that the life insurance industry is actually disruptable? I'm sure that's a word that I can use. So let's start looking at some of the evidence. When we look at the life insurance side, what we're showing you here is, obviously on the left, what do we think the factors that make life insurance vulnerable? And we kind of see three key factors here. Customer loyalty is generally considered to be hard to achieve, excuse me. And so likely that customers can be induced to move elsewhere. Other factor we're seeing is insurance is not bought, it's sold. Now, this prevailing mindset actually threatens to leave the industry open, I think, to a new business model that actually turns this on its head. And the third thing here is that incumbents are typically perceived to be slow to make use of available technologies. And I think this poor perception does impact customer behaviours. Now, from a resilience factor, I think there's two major factors. Excuse me. The first is that manufacturing of insurance is actually a very capital-intensive industry, and so this does limit the types of new entrants that can come into that actually have to have access to quite substantial funding or access to capital. The second thing is that the insurance market, both from a distribution and from a manufacturing perspective, is heavily regulated, and so that is going to limit the opportunity for a disruptor to come in via a kind of low-cost, simplified product structure. But as I did mention under the Uber example, often there is ways of circumventing a lot of these highly regulated environments. On the left here, we've got three components or three boxes or other factors: changing customer attitudes. And I would say that changing customer attitudes is actually a vulnerability for the life insurance industry. And this is how customers are potentially viewing the way that they will interact, buy, share, etc. Access to data and availability of expertise I would typically have put within the resilience side of the balance. However, I think that these two boxes are a lot more fluid and could actually move between being a vulnerability for the industry as well as from a resilience perspective. And I'm going to ask Kenny to now come up and take us through some examples of technologies of why we think that's going to be the case.
Thanks, Paul. So I'm going to take you through a number of specific examples of disruptive technology, potential disruptive technology. I'm going to go quite quick through these, quite whirlwind really. I'm going to stay at a very high level, not much jargon, not much technical aspects of them. Really, two reasons for that. We don't have the time, simply. They're very complex and deep subjects if you get right into them. And a few of the sessions we've had at this conference have attempted to do that. Also, I don't think it would suit our purpose. I really just want to give you a flavour of what's happening there, and so we can discuss it. Now, these technologies are, some of them are already engaged in the life insurance market already. They're already influenced life insurance. We'll talk a little bit about how much further they have to go potentially there. And others are technologies which are being highly used already in general insurance, and we'll see how much of that can transfer over to life insurance. In each case, I'll also give you some examples of specialist companies who are working on these technologies. I've deliberately chosen not to mention insurance companies just to give a more of an outside flavour. Now, I want to start with peer-to-peer or P2P insurance. In a nutshell, this is the ability for customers to take insurance effectively into their own hands. It operates by customers forming into groups, which would typically be family, friends, or colleagues, and within that group have the ability to share within the losses or the gains on the collective policies. Now, peer-to-peer is taken off quite quickly in general insurance, and there's a good few reasons why that is. Touching on the main ones, perhaps, transparency, so customers actually get to see the inner workings of insurance. It's not just a black box they can't really understand. Obviously, lower prices on offer if they have the good experience. And also, there's an elimination of moral hazard, which is an important effect we're seeing in general insurance. And that's due to the fact that the customers have the ability to approve or reject claims. So those making claims have to abide by what other peers are expecting of them. And there are signs that this could have success in life insurance. Let me give you an example. Brood Funds is a Dutch company. It sells income protection to self-employed individuals or entrepreneurs, if you want to call them that. A brood fund is a bread fund in English. It's not a large step to the English version. There are typically 20 to 50 participants in a single brood fund. Those participants pay affordable premiums and can join or leave as they please. It's based on trust. Participants know one another. They can influence the policy of their cover, and doesn't discriminate on age or occupation. Peer Cover is a company that started out in New Zealand, and it covers policy excesses. So peers approve membership, and over 50% of approval is needed in order for a claim to be successful. As with brood funds and peer cover, individuals join or leave as they please and pay for the claim that has been, any claims that have been in their group. Friend Insurance is in Germany, as you'll be able to tell from the flags. It was one of the first peer-to-peer providers. It sells products across motor, household, liability, and mobile. It's actually got 60 domestic insurance partners working with it. The important thing to note about Friend Insurance and about most, if not all, of these examples is that this is a broker model. It's not the manufacturer of insurance. Devara is the British version, sells motor insurance, and like the others, for those who are able to evidence low claims, then they'll eventually receive their premium reductions. Lemonade had a $13 million seed very recently, just last year, and is actually one of the first companies to appoint a chief behavioral officer, which signifies the sort of importance these companies, this peer-to-peer model, is placing on how the customers behave once they're in the peer-to-peer framework. Now, peer-to-peer in life insurance looks somewhat like participating business. The difference lies in the scale, connectivity, and flexibility that's on offer. But ultimately and importantly, they're brokers, not manufacturers of the insurance. Perhaps the biggest challenge in life insurance will be breaking things down into small groups, as a peer-to-peer model needs to do. And that's difficult in an industry where certainty and security are paramount. So telematics, or pay-as-you-live, So this is leveraging the wealth of data being generated from telematic wearable technologies and better price and sell insurance. And the tech that's being used to generate this data is growing at a very impressive rate. I actually got scooped on this yesterday by Colin. So contact lenses that measure blood glucose through your tears. That's something that's been in development by Google. E-textiles, you may have heard of. This is becoming very big in advanced or like elite sports, measuring movement and various other metrics which can help improve athletic performance. There's potential trickle down for that into the population. And then the sort of more run-of-the-mill ones that you'll be familiar with, you probably have on you right now, fitness trackers, of course, and smartphones. The thing that brings all these together is their ability to gather data and then also communicate it outside of the individual. And the data from these technologies will help improve our understanding of risk and help price or segment it further. But also, it allows the ability to change and manage the risk, which is key. And gamification has become a bit of a buzzword in this area. Gamification is the idea of incentivizing customers usually using competition to achieve better outcomes, more positive behavior. Baseline Telematics is a Canadian Montreal-based company that's there on the slide. It specializes in three segments: pay-as-you-drive, pay-as-you-live, and actually pay-as-you-dwell. Pay-as-you-dwell, which is leveraging off of the much-hyped Internet of Things. Baseline and others see the benefits, the technology that's been developed in the motor insurance space transferring over into life. But they appreciate that there's challenges to surmount as well. Of these challenges, I'll name a few. Privacy of customer data is obviously highly important to continue getting the trust of the customer. But also the accuracy of devices. We're not probably there quite yet. I went for a run with my partner on Sunday. I measured 4 kilometers, she measured 5. We went with her number, but which is embarrassingly low, of course. But and also there's a fraud risk as well. There may one day be a time where we're handing our fitness trackers off to somebody who's prepared to do 40 laps of Hyde Park for us. So there's obviously things there that leave it open, but that may change over time. Next one is on blockchain, and I'm surprised not have heard too much about this over the course of this conference so far. So I'm glad, or maybe it's been in a session I've not attended. So blockchain sits behind smart contracts and cryptocurrencies. Bitcoin is one of them, as you probably know. Smart contracts are reducing the human factor in transaction processing and verification. To give you an example of blockchain's application in insurance, I'll give you one now. In the 12 months to May 2015, there were 558,000 passengers who had cover for delayed or cancelled flights, and they didn't claim. In fact, it's believed that just under 40% of individuals with that type of cover who have the ability to claim do not claim. Now, in last year's September London FinTech Week, there was a team involved in one of the challenges there, which built an insurance contract for those customers where the conditions were held on blockchain. The smart contract used publicly available data to trigger the claim when necessary. So a delayed flight is a matter of fact and public record. So the event occurs, the smart contract triggers, and without cost, without delay, the appropriate parties are paid for their claim. Excuse me. Now we can imagine this transferring over into the life space. Obviously, there's perhaps some of the events of late would make us wonder whether maybe terms and conditions need to be tightened for that to happen. And the other use of blockchain is actually in prediction markets. Those who have been following the US elections will have heard of prediction markets being referenced by almost every media outlet who wants to judge how well someone's doing. Effectively, prediction markets are harnessing the wisdom of the crowd. And in fact, some may scoff at that and maybe not quite believe it, but there's actually quite a good academic base for that being valuable. hence why prediction markets have done so well and are continuing to grow. And there's implications here for actuaries. On the face of it, actuaries use deep and liquid financial information to form views about the future. Now, who knows if one day prediction markets will actually be inputting in actuarial models for other non-financial aspects. And sorry, I'll also talk about big data, despite it being a taboo subject yesterday. We are said now to be in the age of big data. Harvard Business School have said that the data scientist is the sexiest job of the 21st century, and I'm guessing that pushes actuary into second, so it's disappointing for all of us here. Big data is a very broad subject, and I'll only cover it very lightly, unfortunately, but hopefully it will give some flavor. It has a vast variety of applications across the insurance value chain. These range from marketing and distribution, personalization of products and cross-selling, customer management insofar as we know our customers better, underwriting and risk management, developing our better risk models, claims management, so the ability to detect large losses early, or using text mining in quotation processes or claims to find indications of fraud. Now, I want to draw a separation between big data and what I would call bigger data, or large amounts of rich data. Big data is characterized by its volume, velocity, variety, and veracity. We will come back to that later. And also, the interesting thing about big data is it has metadata as well. It includes metadata, which is data about the data. So it's quite multidimensional and huge. Bigger data, on the other hand, is data that's typically collected over a long time frame. It's highly rich. It contains lots of detail, and it's actually takes quite a bit of effort to collect too. An example of what I mean by bigger data could be a primary care data set, where that's been accumulated centrally and can be used for medical science, and obviously that could be very valuable for actuaries too, who wish to have a deeper look underneath the surface of claims, underneath the line we draw for mortality curves and so on, understand the processes going on deeper within that. Because we don't just wake up and die one day. Usually there's a process where we go through disease and then get a secondary disease, and that's what ultimately becomes our end. Some people still do wake up and die, unfortunately, too. Aggregators. So it's said actually the best characteristic about life insurance is perhaps its abundance of choice. It's probably intimately linked with one of the worser characteristics, which is complexity and lack of comparability across products. Aggregators attempt to give comparable information on the features and to help customers make better decisions on price. So many sites are already operating in Australia in the aggregator context. And those that work best provide the best prices to this and meet the specific customer needs. And in 2012 and 2015, Google entered the UK and the US with aggregator websites. That was in the general insurance space. It's since actually closed them down. However, in the interim, it did form Alphabet, and Alphabet, being its parent company, the umbrella organization, signifies Google's interest in perhaps broadening out its activities, potentially into financial services. Now, Colin did throw cold water on that yesterday, so I won't predict any more on that, but he did leave it a little bit open. But one of the common cited drawbacks of aggregators is whether they have really the ability to do justice to the nuances of life insurance products, and also the potential for bias if they're linked too intimately to a particular company or distributor. Oops. So, no, wrong way. And on to our last one, Roboadvice. This has grown rapidly in the UK and the US in the last 3 years. In Australia, there's believed to be no fewer than 41 robo-advisors in development or in operation today. That's a statistic, based on just on the end of last year. ASIC themselves have said they're very supportive of the automation of provision of advice and its potential to offer convenient, low-cost services. So that's a promising statement from them. Currently, Roboadvice focuses heavily on the accumulation phase of savings. However, there are several planning to extend into general and life insurance. And the advantages that are experienced by those wealth managers can transfer over equally. These include lowering restrictions, so giving access to advice to beyond just customers who are the mass affluent or wealthy, and giving round-the-clock access to advice too, and reducing the amount of time it takes for a customer to get advice, get good advice. Robo-advisors also have the ability to reduce conflicts of interest and potentially reverse growing lack of trust that's been developed, perhaps since the GFC and various advice scandals along the way around the world. So what does this all mean? I've set out a simplified insurance value chain there on the top. I'd just like to give a sort of view as to where some of these technologies may fit along there. So I've placed them very roughly across that value chain where perhaps their strengths are most visible. Some of them, such as big data, has most likely more wider implications. But just to summarize quickly through these, so we've looked at aggregators, so some doubts over the suitability, but we've already seen examples emerge. Robo-advice promises to bring advice mainstream, and potential to impact insurance is potentially yet to be seen. Big data has a sort of very broad range of impacts, and insurers are working on those as we speak. Telematics, there's still some challenges there, but I think the potential prize on the sales side, potentially in cross-selling, is potentially quite great. P2P, maybe in the life insurance space, perhaps the viability is yet to be fully made clear. And in blockchain, we're still very much in the early stages, but we are seeing general insurance applications growing. So on that, I'll pass back to Paul to conclude.
Thanks, Ken. I probably want to conclude by just asking a series of questions, and I'm not expecting you to answer them, of course. The life insurance industry has strong customer affinity with the life insurer. It has efficient processes, which leads to great customer experience. It's cost-effective, viewed as value for money by the customer. Life companies are nimble and they're able to adapt quickly to changing trends. And then life insurance is sold, not bought, and the customer is the advisor. I think if you think through a lot of those points, it does lead to quite clearly that we should expect disruption in the life insurance space. Potential sources of disruption are numerous, and look, we've covered a few, and I don't think it's going to be blockchain per se, but it might be blockchain combined with robo-advisor combined with big data, and how organisations then will use those combinations. There's various parts of the life insurance value chain that are susceptible or more susceptible to disruption, and so you could see really disruption happening within components of that value chain. Look, that's not to say that the insurance and financial services industry is kind of sitting still and waiting for these disruptors to come. I think there's been a lot of investment now within the industry, and I'm going to use the industry here to mean life insurers, and if they're owned by banks, they're banks, and then if they're owned by a global company, the global company. We've seen the establishment of innovation labs, particularly by a lot of the kind of regional global players, and also through the banking group, financial services organisations. We've seen groups now taking either a percentage share or taking full ownership of a lot of these innovative technologies. The banks have definitely invested directly in a lot of blockchain or organisations that are utilising blockchain technologies. And even if you then go down more to the micro level, I mean, a lot of companies are now set up they'll have a chief digital distribution person or a head of data analytics, head of customer experience, etc. And so, look, I think insurers are acknowledging the potential for disruption and are trying to manage that through various means. I mean, interestingly, with a lot of this investment, are insurers almost leading to their own disruption? I'll finish with a quote from Winston Churchill. It's not the end, it's not even the beginning of the end, but it is perhaps the end of the beginning. Thank you.